Are you looking forward to close your company but do not have complete information on the methods involved, minimum requirements and procedure for doing so? Well, then you have clicked on the right video. Hi, I am Tushar Bakshi, a startup advisor at Setindiabiz, where we provide tax, compliance and IPR services to businesses and startups across India. In this video, I will discuss number 1, the ways of closing a company, 2, the meaning of striking off and winding up a company, 3, the legal provisions of striking off a company, 4th, checklist to strike off a company, and 5th, the process and documents required to strike off a company. So let's begin without any delay. So what are the ways of closing a company? You can close a company in 2 different ways based on their status of activity. If the company is defunct, which means it is neither conducting any business activity nor carrying out any business transactions and neither has any asset nor any liability in its name, you can apply for its striking off to the Registrar of Companies, that is ROC. And I will explain that what striking off really means after a few seconds. But what if your private limited company is absolutely functional? It is actively conducting its business activities and even has assets and liabilities in the name. Can you still close it off? Well, yes. The process is called winding up and is carried out by the National Company Law Tribunal or NCLT. But how is it different from striking off a company? Let us understand. Winding up a company. Well, winding up is the permanent closure of an active company, which means once a company is wound up, it cannot be restored back to normal. The process is a little bit complicated. You see, a company can be wound up voluntarily or forcefully by the NCLT subject to certain conditions. In either case, the NCLT will initiate legal proceedings against the company to make sure that it is eligible to be wound up in the first place. Also, an insolvency professional will be appointed to sell all its assets and settle all its dues, as the company cannot show assets or liabilities in its name after being wound up. Now compare this with striking off a company. Striking off a company. Striking off is the temporary closure of an inactive company. Why temporary? Well, because even after being struck off, it can be restored to normal within a time frame of 20 years from the date on which such strike-off was effected. Moreover, the process is way simpler and easier compared to the legally complicated process of winding up. A company can be struck off voluntarily by filing an application to the Registrar of Companies. Since it is already defunct, it will obviously have no assets or liabilities in its name before the application is filed. However, if any liabilities arise after the filing of the application, the concerned amount will be collectively paid off by all its directors. Once the application is approved by the registrar, it will simply remove the name of the company from the registrar of the incorporated companies and LLPs it maintains. Now, that we have a brief idea of what striking off really means, let us discuss the legal provisions related to it. Legal provisions for striking off a company. Section 248 of the Companies Act mentions 4 conditions for striking off a company. Among these, even if any one condition is satisfied, the company becomes eligible for striking off by the ROC on its own or on an application filed before it. So let us go through the conditions one by one. Number 1. The company is inactive since its incorporation. This means that the company has not conducted any business activity or carried out any business transaction for 1 entire year after incorporation. Also, in this 1 year, the company has 0 assets and liabilities in its name. Number 2. The company has been inactive for 2 financial years immediately preceding the date on which the striking off application has been filed. And further, it has not applied for dormant status in any of these 2 years. Number 3. The shareholders of the company have not paid their due subscribed capital within 180 days from the date of incorporation. Number 4. The company is not carrying out any business activity as revealed in the ROC's report relate to the physical verification of its registered office. I repeat, if any of these 4 conditions are satisfied, the company will be eligible for strike off by the ROC, whether voluntarily or forcefully. So, fulfilling a condition under Section 248 is definitely important, but certainly not enough. There are a few other tasks that have to be completed before the application for strike off is filed to the ROC. Allow me to explain what these tasks are. Checklist to strike off a company. Before filing the application for striking off a company, you must ensure that number 1, the company is fulfilling any one condition under Section 248 of the Companies Act. 2. At least 75% of its shareholders have passed a resolution approving the decision to strike off the company. 3. All the liabilities and government dues in the name of the company have been cleared before the period of its inactivity. 4th, the current bank account of the company has been closed, and a letter of closure along with the closing bank statement have been received from the banker. 5th, the company did not have any asset or liability in the period for which it has been inactive. 6th, the company has no pending litigation against it in any court of law. And lastly, 7th, the digital signature certificates and director identification number of all its directors are valid and active. So, once you are sure of these, you can finally begin the process of voluntarily striking off your company. Process of striking off a company. Before we begin our discussion on the process, let us first analyze as to why would one want to strike off a company. What are the benefits that striking off generally offers? Well, in this context, you must realize that businesses cannot be operated without ups and downs. In the world of businesses, things are not always hunky-dory and in your favor. You will face situations when your company, after operating successfully for decades, has suddenly stopped generating revenues, or your startup has after all failed to kickstart its operations. Even in these hard times, your company will have to bear its legal costs, which is a huge burden. And the only way out is to willingly strike off your company and later restore it when your company revives its financial health. This is a total win solution for you, as you will not only be able to get rid of all the legal compliances, fees and penalties to be paid by your company in the due course of its inactivity, but will also be able to utilize its resources in a better way. Now that you know the benefits you will receive by striking off a defunct company, let's go through the stepwise process of doing so. Step number 1. Documentation. As we always recommend, the first step of any application-based process like this one is to arrange all the necessary documents beforehand. The reason we do so is that we consider documentation to be the most important aspect of an application. So much so that any inaccuracy or inadequacy in filing these can lead to a total rejection of your application. So, if you arrange all the documents beforehand, you will not only be able to prevent any hindrances in the later stages, but will also drastically be able to smoothen the entire filing process. To know about the documents required for striking off a company, stay tuned till the end of this video. Step number 2. Obtaining the consent of shareholders. Once all the documents are arranged, at least 75% of the company's shareholders must approve the decision to strike off the company. Such approval can either be obtained in the prescribed consent form, or an extraordinary general meeting can be convened to pass a resolution to this effect. The consent form or the resolution, whichever it is, will have to be submitted to the ROC at the time of application. Step number 3. Surrender registrations and licenses. If the company has obtained any legal registration or licenses, they need to be surrendered. Now, there are some registration and licenses which can be surrendered before the company is struck off, while others which can be surrendered only after the company is struck off. For instance, EPF registration, ESI registration, PAN, TAN, and Import-Export Code can be surrendered only after the company is struck off. But GST registration can be surrendered before its striking off as well. Step number 4. Close bank account and prepare financial statements. As I mentioned earlier, the current bank account opened in the name of the company needs to be closed before the application is filed. You will also have to get the account closure letter and closing statements from the concerned banker. The next step is to get a practicing chartered accountant to draft and certify the financial statements of the company, showing nil assets and liabilities for the period in which it was inactive. Step number 5. Prepare affidavits and indemnity bonds. All directors must prepare affidavits declaring the company's inactivity for the said period, as mentioned in the application. The ROC will rely on these affidavit declarations while examining the eligibility of the company to get struck off. Along with the affidavits, the director will also have to prepare indemnity bonds, undertaking collective responsibility to pay off the company's dues arising after it has been struck off. Both these documents must be drafted on stamp papers of appropriate value and must be signed by all the directors in the presence of a public notary. The notary will later have to stamp both these documents. Step number 6. Appoint authorized person. One of the directors needs to be authorized as the representative of the company for filing the application. For this, a board meeting will have to be convened where the directors will pass an ordinary resolution to appoint the authorized representative of the company for the purpose of filing the application. Step number 7. File application. Finally, we reach to the last step, which is the filing of STK-2 application for striking off the company. The form is available online on the official website of Ministry of Corporate Affairs. You can download the form from here, fill it out manually and then upload its scanned copy on the site, along with the scanned copies of all the necessary documents and the digital signature certificate of the authorized representative. Once everything is uploaded, the form can finally be submitted with the government fees of Rs 10,000. The submitted application will reach the ROC and after a thorough examination, it will get approved. Subsequently, the ROC will notify its intention to strike off the company in the official gazette. The notification will be active for a month, and meanwhile, if no objections are received from the general public against the ROC's decision to strike off the company, the strike-off will finally get effected. With this, we come to the end of the process of striking off a company. But we are yet to discuss the list of the required documents. So, documents required for striking off a company. There are only 10 documents required for striking off a company, and let me list them one by one. Number 1. Indemnity bonds drafted on a stamp paper signed by all the directors and stamped by the public notary. Number 2. Affidavit declaration drafted on a stamp paper signed by all the directors and stamped by the public notary. Number 3. Copies of consent or original copy of resolution passed by at least 75% of the company's shareholders approving the decision to strike off the company. The resolution must be certified by the company's directors as well. Number 4. Board resolution authorizing any one director, managing director, manager, or secretary to sign Form STK-2 using a DSC. Number 5. Statement of accounts showing nil assets and liabilities duly certified by a practicing CA. Number 6. Statement of pending litigations of the company, if any. Number 7. Bank closure statements and bank closure letter. Number 8. All ITRs and returns filed to the ROC when the company was active. Number 9. No objection certificate from the sectoral regulator if applicable. And finally, 10th, authorization letter of the authorized representative signed by all shareholders. With this, we have come to the end of this video. Hopefully, by now you have complete knowledge on striking off a company in India. If you still have further questions, you can ask us in the comments below. And if you wish to learn more, you can simply visit our website or contact our expert startup advisors or call or WhatsApp. Links are given in the description box. And if you found this video helpful, hit the like button, share it with your friends and colleagues, subscribe to our channel for more informative content ahead. Do not forget to click on the notification bell so every time we post a new video, you are the first one to get notified. Thank you for watching. Watch our other videos as well.